The e-commerce platform specialist Shopify has been a very popular stock in the market for a long time. It's a stock that I frequently get asked to share my thoughts and opinion on, and yet it's a stock that I've never really covered much on the channel. And I think the reason why, at least for me, is because I already had some online shopping exposure to companies like Amazon and Alibaba who I'm invested in. But at the same time, whenever I would look at Shopify, I always felt like the stock was just trading too high. It was always kind of skyrocketing. The valuation was very expensive. And so I always felt like Shopify was just a bit too far out of reach for me. Well, fast forward to today, and the stock has been crashing in recent months. It's down around 60% from its highs at the time of this recording. And so, with that in mind, do we think that right now is the perfect time to finally be picking up some shares of Shopify stock? Or even after the crash, is it still just too expensive for me to be adding to my portfolio? Let's find out together. Let's get started. What's up, everyone? My name is Ale. Welcome back to my world of stocks. All right, let's go ahead and start by just pulling up the stock chart. We'll talk about why it's been crashing. I'll let you know how I feel about them, where I see them headed in the future, and whether or not I'll be buying any shares myself. But first, let me just give you guys a super quick intro into what Shopify is and what they do, in case you don't know a whole lot about them. But this is, of course, an e-commerce company that, unlike Amazon or eBay, who sell you stuff through their brand name platform, Shopify actually helps primarily small to medium-sized businesses set up their own online shopping infrastructure powered and facilitated by Shopify to simplify the entire process and get everything up and running for their online store. And they not only provide various tools, services, and valuable customer service support, but they'll even help you with your physical brick and mortar stores too by digitalizing it and using point of sale hardware and software that syncs together with the entire Shopify ecosystem. So basically you can sell anything you want, anywhere you want, and Shopify will track all your sales, they'll process the payments, they'll keep track of your inventory, it can give you different options like delivery or store pickup, and they even have multiple pricing tiers depending on which of their various services you need. Prices can be as low as $30 a month and climb all the way up to thousands of dollars really for the larger brands. Speaking of which, while Shopify's user base is primarily made up of entrepreneurs and smaller businesses, it should be noted that they do have larger well-known brands using their products as well, like even Coors, Heineken, Staples, Heinz, the giant General Mills. There's even GE, Nestle, and Unilever. And you've even got celebrities like Kylie Jenner, Eminem, Justin Bieber, and Kanye West all using the premium plus tier of Shopify as well. And I think what really sets Shopify apart in the world is the fact that they truly are that, one of those kind of all-in-one type of companies when it comes to managing a retail business, especially online. And that's led to a ton of success for them so far. Their client base has already climbed to over 1.7 million users across 175 different countries. They've taken over the most market share as an e-commerce platform provider at over 30% market share, and their sales have been exploding over the years, especially in 2020 and 2021 during the pandemic, with so many people turning to online shopping, where they were able to grow their sales by a monstrous 85% and still another 57% respectively. And even coming off of that, with things opening back up, they're still managing to put up over 30% growth per year, which is very impressive, or at least that's what analysts are expecting. But anyway, even with these growth numbers and the most market share, Shopify still has massive long-term potential. First of all, they did less than $5 billion in sales last year, which, don't get me wrong, that's obviously a giant amount of money, but it's really nothing compared to their total addressable market of $160 billion. That's a huge market opportunity, and one that continues to get even bigger. Over time, e-commerce sales have gradually become a larger part of total retail, having already reached about $5 trillion, and most of those sales are actually outside of the United States. The US only makes up around 20% of all online sales. And the reason I mention this is because only around a fifth of all Shopify's sales even come from outside the US, meaning they've got a gigantic opportunity to expand internationally where the market is really booming. And that's probably where you're going to see much of their growth in the coming years and over the longer term. But that kind of 1-2 punch of excellent performance and lots of future potential initially sent the stock skyrocketing from less than $100 a share in 2017 all the way up to over $1,700 just a few months ago, which was an increase of around 4,000%. That is before it got absolutely destroyed in recent months, crashing all the way back down to around the $600 and $700 ranges for a drop of around 60% from its highs, which begs the question, why the heck did it crash, and is now the perfect time to start buying the stock after the drop? Well, I don't really think that we have to overcomplicate anything here. What we're seeing is a typical case of a super expensive tech stock during a very weak economic and geopolitical climate, where investors are turning away to more trusted conservative stocks with bigger names, low valuations, and sometimes even dividends. And when looking at the economy, US inflation has hit a 4-decade high. Gas prices are at the highest level in our entire history, and as a result of inflation, the Federal Reserve is having to raise rates for the first time in over 3 years, with another 6 rate hikes expected this year alone. And on top of all of that, we have geopolitical warfare between Russia and Ukraine that could potentially escalate to something much larger if we don't quickly figure out a peaceful solution. As such, you've seen a gigantic shift away from highly valued tech stocks, many of which have been getting absolutely destroyed in recent months, with Shopify being no exception. And to be honest, it kind of makes sense. There was really too much hype building up during the pandemic for these internet-based companies, and that sent Shopify's valuation skyrocketing to really unreasonable levels. At one point in 2020, their trailing P/E ratio had reached more than 700, and in 2021, their forward P/E ratio was still more than 400. And all the meanwhile, even their price to sales ratio, which is not even looking at profits, just sales, it still hovered around 50 or more. Now, if you're not familiar with those valuation metrics, just know that they were unbelievably high and considered extremely expensive, even for a high growth tech stock. Now, coming off of that, after the recent crash, Shopify's valuation has thankfully come way down, as their forward P ratio is now within the 200s, and because of their tremendous growth, it is eventually expected to fall all the way down to less than 25, which would actually be a very good valuation for a high growth tech stock like this. The only problem is that that's not expected to happen until all the way in 2026. So the question you got to ask yourself is, are you willing to hold a stock like this for such a long time until it finally grows into that valuation? Are you looking for a long-term investment, and do you have the strong mindset of holding through all the volatility and corrections and bear markets and maybe even crashes in this stock market through the years to come, while you build up a larger position during such a weak macroeconomy kind of period, and ideally get to collect some great profits over the long term, assuming that the company performs well during that time? Or would you prefer picking up some smaller growth companies, but ones with much cheaper valuations that are probably safer bets through these uncertain times? I mean, you could even get a massively large company like Google, that is one of the safest and most profitable companies out there, for a forward PE ratio that is already lower than 25 and a PEG ratio that is less than 1, and still a double-digit growth rate of around 15 to 20% a year, despite already doing over $250 billion in sales last year alone. That's, very impressive for a stock like that. Now, still, to be fair, the two companies are very different, and Shopify has always had their loyal investor base that really pumps up the stock on any good news, which seems like that could be at any moment now, considering how much the stock has already crashed and is likely oversold. So maybe now is actually a good time to buy the stock regardless of the valuation. Time will tell. Unfortunately, there's only 3 analyst price targets on Yahoo Finance, but all 3 of them think that the stock will either double or even triple from today's lower prices. I admit it's a tough one to decide on. I think long-term investors that believe in the company have a very good opportunity here to pick up a stock that has almost entirely wiped away all of its pandemic-fueled gains, despite the company being in much better shape today than it was back then, and is also starting to ramp up profitability. And then it's also competing, and not just competing, but actually dominating a market that in itself is growing by a huge amount and is already very large. And then all the meanwhile, they still have the long-term catalyst, which is a very big one, of international expansion. So when you look at it, I mean, what's not to like here? Well, I think for me, what's not to like is the fairly rich valuation, even after the huge crash, which, by the way, gives you an idea of just how expensive it was trading before that. Now, you could look at that optimistically and say, well, they reached those highs before, maybe they can reach those highs again in the future. That's a fair point. But for me personally, I've actually been picking up too many spec stocks recently, been adding too much risk to my portfolio that I'm actually trying to cut down on. I'm trying to focus a little more on some value, some more solid companies, bigger companies that have more profits and ideally even pay dividends. Those are the things that I'm in the market for. But if I was in the market for something like Shopify, by the way, I know Shopify is profitable. I don't necessarily think of them as a speculative stock, but I do a little bit just because of the rich valuation. Just because it's a bit expensive, I do still consider them a little higher risk or a little more speculative. But if I was in the market for that, Shopify would be at the top of the list. In fact, if the stock keeps falling or they start growing more so into the valuation, or I get to the point with my portfolio where I can start adding back a little bit of risk to it, Shopify is going to be right up there, right near the top of the list of stocks that I'll be looking to pick up. So I really like Shopify. I would love to own it. It's just one of those stocks that is always just a bit too far out of reach for me. And I've just always been a little too hesitant to pull the trigger. I'm a little more cautious on it, but I really like them. You guys do what you want to do. Let me know down in the comment section. Do you own it? Are you looking to pick up shares? And if so, why? What do you think about them long term? Yeah, there's a lot to like there, but let me know what you think. I'll try to respond to as many comments as I can. Thank you so much for stopping by. I hope you enjoyed the video. I will catch you guys in the next one. Take care. Bye-bye.